Welcome to the range section of the course. Understanding and being able to identify range is a very essential component to being a successful price action trader. So, what is range? Range is when support and resistance is formed. The area between the upper and lower limits of support and resistance is a range. This is not to be confused with consolidation, which is a similar concept but pertains more to market structure. Consolidation is something we'll cover during your mentorship. I personally prefer to identify range on the 1 hour time frame. I then adjust my levels on the 15-minute time frame because this is the time frame in which we'll enter our trades. I mark my support and resistance by placing a line on the body of the candles, meaning the open or the close, and not at the wicks. I also highlight the line with a rectangle partially on the candle's body and partially on the chart. This is just to emphasize the zone, and it allows the markings to stand out on the charts. And there you have it, a simple range, which includes support and resistance. We can identify our range by looking at bullish and bearish candles. A bullish candle after a bearish candle normally indicates support formed. And a bearish candle after a bullish candle normally indicates resistance formed. In addition to defining the range, we must identify clean traffic. What is clean traffic? Clean traffic are impulse moves of price to the upside or downside. There are points in the market where price was able to move easily. Similar to when driving on the road, when there's not many cars in the way, this is known as clean traffic. And when there's many cars in the way, this is known as traffic or a traffic jam. Traffic jams are usually caused by minor supports or minor resistance. Most important to note is that at the beginning and end of clean traffic is always a range. Here's our range to the left, and then you can see the clean traffic or impulse formed to the upside. Price was choppy for a bit after that, but when volume came into the market after a small range, price made an impulse or clean traffic to the downside, formed a small range and more clean traffic to the downside, where it formed another range. At the end of this range, it formed more clean traffic to the downside before ranging again. At the beginning and end of clean traffic is a range. Range, clean traffic, range. Clean traffic presents the best trading opportunities. Time and time again, price moves in the same manner when approaching previous areas of clean traffic. Price will mirror the same movements that was done in the past. Here we have clean traffic to the left that came down and went into a range. Then price broke outside of the range to the upside, mirroring the clean traffic to the left. This is why clean traffic presents the best trading opportunities. Probability has it that price will often repeat the same moves it has made in the past, especially with clean traffic. We're looking to take trades that break outside of the range. But what happens when price breaks outside of the range with a candle closure, followed by the next candle closing back inside of the range? This is called a fake out or false breakout, and it normally occurs to the opposite side of the trend. A good reason to never trade against the trend. Let's take a look at false breakouts or fake outs. Here we have price in a range and it's in a downtrend. We have a bullish candle that managed to break above the resistance and close. At this point, many traders would assume it's time for buys, as we have a candle that closed above the resistance, which is something that these other candles couldn't do as they all rejected at the resistance, leaving these wicks. But if you were of the opinion to take buys, you would have been faked out. As you can see, the next candle was bearish and closed slightly below the resistance back into the range, and even filled the entire range, continuing the downtrend. You could have avoided this loss altogether by just staying away from counter trend trades, as we already established that price is currently in a downtrend. If trading is about having the best probable setups for profits, then it does us a disservice to lower our probability by trading against the trend. If we trade solely with the trend, we increase our probability for winning trades and avoid becoming victims of false breakouts or fakeouts. The biggest way to avoid fakeouts is by following the trend until it breaks. We can identify a trend change and change our bias accordingly if price wins a trend challenge, which you learned about in the trend section. Being able to identify the range is a key component of price action trading. We identify the range and then we identify the breakout. Always remember, at the beginning and end of a range is clean traffic. We use trend for our bias, range for our setups, and candle confirmations for our entries. Combining all of these confluences will help us identify the perfect timing to enter a buy or sell trade. I'll catch you in the next section, entries and exits.